All right, so moving on. What are the advantages of registering a corporation? Well, there's a few. So, the biggest one is simply limited liability. A shareholder, when they choose to invest in a company, their exposure to the debts of that company is limited to simply their investment. They don't incur additional obligations that the business might incur onto themselves individually. Next, there's a separation of ownership from the management. So the shareholders own the company, and they don't have the right to participate in management. Now, you would think this is a disadvantage, but it's actually an advantage because it means that as an owner of a company, there's no need to follow the day to day ups and downs and runnings of a business. Instead, a shareholder can own the business and let other people run it. This is why people want to invest in things like Google and Amazon. They don't expect to actually go and run the operations of Amazon, but they do want to take part in the growth of that company. So, free transferability of interests. So, without a contractual or legal restriction, ownership in the form of shares in a corporation can be freely exchanged and transferred, and therefore, because the value fluctuates up and down, it makes a gift where I might be too old and I might be like 100 years old and I'm going to die. I'm able to just simply devise, which is write a will to one of my family members, and they would take ownership of that share in the company. Next, it's perpetual life. A corporation has no termination date that's baked in, unlike other forms of business, like a joint venture, let's say, which is limited by the contractual terms of the joint venture. In a corporation, it exists forever, unless, of course, the articles of incorporation provide for a shorter life, or if the government comes and dissolves it for whatever reason. But in most instances, a corporation has perpetual existence. Next, the ease of raising capital is a huge benefit, where a corporation, in order to expand or ramp up their business operations, they can sell stock or issue bonds in their company, and that will raise the money to then go and do things. And it's a vehicle for a company's management to leverage their perceived value into actual capital. Then the next one is a big one, which is constitutional rights. So has, if you're familiar with the Citizens United case, in which the Supreme Court ruled that a corporation is, in all intents and purposes, a person, and that therefore they're able to enjoy the freedom of speech, which is a constitutional protection. In that holding, the Supreme Court also held that money and donations for money is considered speech. I have my own qualms about the actual ruling, but it hits at the heart of this actual advantage, which is because a corporation is considered a person for most purposes under our Constitution, it has all of these constitutional protections. So that would be the right to equal protection, the right to due process, the right to freedom from unreasonable search and seizure, and the right to freedom of speech. This is a big one. This allows corporations to leverage their vast amounts of resources to operate within our political climate. Next is transfers of property to a controlled corporation. A transfer of assets for shares of any corporation is tax-free if the transferors gain control immediately after the exchange. Two or more transferors of appreciated property receive a benefit if together they meet the control test. Property includes money. So this is an example in which there's a merger or an acquisition between one company that extends capital to own the assets or shares of another company, and those are not taxed. So there's no such thing as an inheritance tax, a gift tax, that type of thing. A merger is actually very lucrative for these companies because they're able to essentially convert the assets that they hold into other assets through a transfer, and none of that is taxed. So what are some disadvantages? So the first is that there's reduced individual control of a business that's operated by the managers. Over time, there might be 1,000 people that own share in a company, and the company's CEO and CFO and COO don't operate in the interest of the shareholders, or at least there's disagreements, and therefore there's less control over what these managers do that run the operations. Next is that taxes are paid on the corporate income, and any dividends or payment to the shareholders from like good performance in a specific quarter, those distributions are taxed onto the shareholders. So there's a lot of taxes. Next is there's a substantial cost to create a corporation and to sustain the legal and tax obligations through payments to lawyers and accountants. It's just expensive to operate a corporation. Next is the state and the federal government regulate heavily these sectors, especially when it comes to securities, which are stocks and bonds. Next is if it's a company that's traded publicly in which sales of its shares are available to the general public, there is essentially a mechanism for the government to take over that company. Maybe the government comes in and forces the company to liquidate, or forces the company to be owned by another company, that kind of thing. Next is the sale or other transfer of unrestricted shares. So in a closed corporation, a closely held corporation, like I said before, in which all the shares are owned privately and the managers tend to be the owners, like White Castle was the example I used, is the shares within that closely held corporation could be transferred in an unrestricted manner, and that leads to obscurity and opaqueness when it comes to the internal operations of these close corporations. Last is there's an inability of a minority shareholder, so someone in a closed corporation that is a minority shareholder, to liquidate his or her interest or to influence the conduct of the business. Is essentially the people that hold the most shares have the most say in a corporation, especially if it's a closely held one. So if the minority shareholder wanted just to get out of it, the majority could actually be like, no, you can't liquidate your interest yet, or you liquidate it, but you have to pay more money, that kind of thing. So next we'll go into the holistic section, where we'll summarize the two corporate entities. So as I mentioned before, there's the S corporation and the C corporation. And we'll go from left to right, starting with the leftmost column, which is formation. So as you can see here, formalities are pretty similar. They are both formed the same way by filing articles of incorporation with the state. The only difference is that the S corporation elects to be an S corporation during or after filing. So that's formation. Then for capitalization is the S corporation is limited to 100 shareholders, as you recall, whereas a C corporation is not limited that way. Next is operation. Exactly the same. There's no difference. Shareholders elect the board appoints the officers. Same. Liability. So in an S corporation, actually, for both, they're the same for liability as well, in which shareholders are liable only to the extent of their investment. Next is transferability. It's pretty much the same, in which shareholders may transfer their interest, but in an S corporation, there's more restrictions, where that transfer has to be to other qualifying shareholders, because, as I mentioned, shareholders in an S corp cannot exceed more than 100. Lastly, the S corporation and the C corporation's biggest difference is taxation, in which the S corporation has flow-through taxation, And the C corporation has corporate income taxation. Last is the S corporation must continually qualify as an S corp for each tax year, or it reverts to a C corp. A C corp is just a C corp. It doesn't end until the business terminates. It exists forever. So going back to everything that we covered, this is again a summary of the non-corporate business entities. So these are the general partnership, the limited partnership, the limited liability partnership, and the LLC, limited liability company. So with formation, you can see here that the general partnership is the one that doesn't need formal filing, whereas the other three do. So that's a big benefit for the general partnership when it comes to cost savings. For capitalization, it's essentially either in a resources of the general partners, resources of the general and limited partner, or resources of partners and contributions of members. And so these are very similar. Is the only difference is that there's partners and then there's members, but pretty self-explanatory. Then for operation, so a general partnership is the most, I guess you could say, the most helpful for the partner, but the most restrictive for including more partners. That would be the general partnership, because each partner has the right to equal participation and each partner can restrict management, right? The limited partnership, it's the same, but the limited partner has no management rights at all. So there's an advantage there in which there might be more people at the table, more people to put in money to a limited partnership, but the general partners still maintain management rights. Then, for the limited liability partnership, these are good for professionals because they're limited to essentially being part of a specific profession or expertise. And the benefit here is that it's easy to form, but it operates with limited liability, much in the same way like an LLC. Next, the limited liability company. So all members have equal management rights, very similar to a general partnership. So as with the rest, you can go into them. I'm going to move on to more of a summary now. So what is the difference between all of these, and what are some ways to go about it? I'm not going to read through this. You should read this on your own, but just remember that a sole proprietorship is the easiest, and then the other three, the general partnership, the corporation, and the limited liability company, all have their own pros and cons and differences. So the pros and cons are here. Take a look at this on your own. I'm not going to go too heavily into this, but this is a very, very good sheet for you to refer to if you were considering starting your own business, whether if you want to choose a professional career where you become a CPA or become an attorney and create your own I guess, professional limited liability partnership, or if you want to come together with more than another person, maybe you want to form a C corporation. The S corporation would be the furthest scenario or furthest type of entity from a startup business because it requires pretty sophisticated management of the finances and the various legal complexities. And generally, I would say if it were a cookie cutter business, right? Let's say you want to sell flowers. What I would do is I would start as a sole proprietorship. I would take investments and money and use a checking account to run the sole proprietorship. Once I have enough money, I might actually then go and talk to someone else who wants to partner with me, and we would form a partnership. Then over time, I would then file a LLC and then operate that way before becoming a C corporation. So that's how I would go about it.